Something just cracked wide open in the silver market. Not tomorrow, not next week. Right now, while most investors are still staring at headlines that are 12 hours behind the actual data, the structure that kept a lid on silver for days, that ceiling between 8,720 and 89, it just gave way. The price punched through with a confirmed hourly close above resistance, ran all the way up to 91.14, and has since pulled back to hold steady at 90. The structure is still intact, the move is still live, and 48 hours from now, the March settlement window closes permanently. Whatever is going to happen is already in motion, and the data trail it is leaving behind is worth every single minute of your attention. This is OG John AG. And what I'm about to walk you through is not a price prediction. It is not a buy signal. It is a data-driven map of every single pressure point building up at the same time in the silver market right now. The futures market, the physical vaults, the Shanghai exchange, the Mexico supply chain, and the psychology of a short position that just watched its last clean exit window slam completely shut. If you have been watching this channel through this cycle, you already know how to read these setups. You understand that we track structure before the move happens, not after. If you are new here, the best decision you can make right now is to subscribe and follow along in real time, because what is unfolding over the next 48 hours is the kind of structural market event that most financial channels will not cover until after the fact. After the price has already moved, after the settlement is closed, after the window is completely gone. You are here before the after. That matters more than most people even realize. Let's start with the number that reframes everything else in this picture. The CME registered silver imbalance. Registered silver at CME, the actual audited, physically deliverable ounces sitting in approved vaults that can legally be used to settle silver futures contracts, has now fallen to 87.2 million ounces. That number did not stay flat. On Tuesday alone, another 1 million ounces were removed from registered stocks, not added, removed. Cross that 87.2 million against total open interest entering this settlement window, which stands at 115 million ounces. That gap, 115 million ounces of paper obligation, sitting on top of 87.2 million ounces of available physical, is not a rounding error, and it is not a technicality. It is a structural imbalance that has been getting wider, not narrower, as settlement approaches. Here is the detail that most commentary has completely glossed over, and it is the one worth really sitting with. Not all of that registered silver is equally easy to get to. Physical ownership within CME vaults is not spread out evenly across all market participants. Some of those 87.2 million ounces are held in big concentrated chunks, not spread out fairly across all short positions. So the assumption that as long as the total open interest falls below the total registered stocks, all short positions are safe until the May contract, that assumption is structurally wrong. Uneven distribution means delivery pressure can concentrate hard against specific positions even when the top-line numbers look totally manageable on the surface. That is a critical distinction. It is the difference between a market that settles cleanly and one that develops localized delivery stress that the headline data does not immediately capture. Analyzing the largest single-day roll. Now hold that thought, because the roll data from yesterday adds an entirely different dimension to this picture. 71 million ounces were rolled in a single day. That is the largest single-day roll recorded in this entire cycle. The force majeure conversations that were burning through market commentary last month. The scary scenarios where physical delivery failures cascade into something completely unmanageable. Those scenarios appear to be off the table based on yesterday's data. The roll happened, positions moved, settlement pressure was pushed back. And here is what matters most about how that roll actually executed. The price did not fall during it. The price moved higher. When a roll of that massive size executes 71 million ounces in a single session, and the market's response is to move upward rather than downward, the market is telling you something very precise. Demand for physical silver at these price levels is not weakening under pressure. It is holding, and in some measures it is actually strengthening. But something equally important did not happen alongside that roll. No new metal came in. Not a single ounce was added to registered stocks on the day of the largest roll this cycle has seen. The longer that pattern persists, outflows without replacement, delivery pressure pushed back but not dissolved, the more the structural pressure builds quietly beneath the surface. This is the exact mechanism that drives sustained moves in physical commodity markets. It does not announce itself loudly. It builds quietly, one delivery cycle at a time, until the gap between paper and physical becomes impossible for the market to ignore. Pull up CME open interest right now while this is playing. Look at the registered silver figure. Look at the open interest figure. Look at the gap between them. Then ask yourself, in a normal healthy futures market approaching settlement, which direction should those two numbers be moving relative to each other? Because what you're looking at right now should not be possible at this stage of a typical settlement cycle. Drop what you see in the comments. Now let's move east. because what is happening in Shanghai right now is not just a supporting footnote to the Western data. It is in force the $10 Shanghai premium and global repricing, independent pressure variable that is amplifying everything else at the same time. Shanghai Futures Exchange Silver closed the session at 100. Western spot silver is trading at 90. Shanghai Futures settled at 104. That means the premium of physical silver in Asia over the paper price in the West is currently sitting at $10 per ounce. And it is not narrowing, it is widening. Gold closed in Shanghai at 521,134. Palladium closed up 4.5% on the session. Platinum closed up 7.03%. This is not a one-metal story, and it is not a one-exchange story. The entire precious metals complex is repricing at the same time, with silver sitting right at the center of the most concentrated structural stress. A $10 persistent premium between physical demand in Asia and paper pricing in the West is not temporary arbitrage, just waiting to be closed by some clever trader with access to both markets. Persistent widening premiums of this scale signal structural dislocation, a condition where the price being quoted on Western screens has increasingly little relationship to what actual buyers in Asia are paying to take physical delivery of real vaulted deliverable silver. When that gap persists for multiple sessions and grows rather than shrinks, it means the arbitrage mechanism that should naturally close it is either not functioning or is being actively prevented from functioning. Either of those explanations carries serious implications for where physical price discovery ultimately lands. And now SHFE account suspensions and exchange intervention. Here is the detail that should stop every serious market participant cold. The Shanghai Futures Exchange has suspended 25 trading groups in the month of February alone. The cited violations accounts exceeding daily opening limits and breaching exchange trading rules under Article 16. The official language is procedural and clean. The translation is not. You do not suspend 25 trading groups in a single calendar month unless something genuinely abnormal is happening in position sizing, risk concentration, or both. Exchanges do not act preemptively, they act reactively, and they act when the risk profile of concentrated positions threatens delivery integrity or market stability. The SHFE publishes these suspension notices publicly. This is not speculation or interpretation. It is documented, verifiable enforcement action. Go look at the suspension notices yourself, they are right there. When a major physical commodity exchange starts enforcing position limits at this frequency and this scale, it is confirming that the setup being described in the data is real. It means crowd positioning was extreme enough that the exchange itself felt it had to step in, and that intervention changes the psychology of every remaining position still watching from the outside. In a moment, there is one more pressure variable entering this picture that recontextualizes everything you have just heard about silver supply. But first, the technical structure. Because levels identified before price technical analysis, resistance flips to supports, arrives at them, tell a very different story than levels identified after. Silver's 50-day moving average is currently sitting at 81. Price is trading at 91.14, which puts it more than 10 points above that moving average. Here is the detail that matters more than the current distance. Since May 30th, the 50-day moving average has not declined once. Not a single session of decline. That is not a bounce off a low. That is not a relief rally. A rising moving average, with price consistently holding above it, across multiple months, is the textbook technical definition of sustained bull market trending behavior. It means the trend has internal momentum that is not dependent on any single session's price action to remain valid. For the chart readers following along, here is the structure in real time. Resistance was identified before the move at the zone between 8,720 and 89. Price approached that zone, tested it across multiple sessions, and then broke through with a confirmed hourly close above the upper boundary of resistance. It ran to 91.14. It has since pulled back to 90. Former resistance is now acting as support on the lower timeframes. The next technical objective based on measured structure is 92. This is what it means to read price structure before the move rather than after. You identify the levels, you watch price respond to them, and you track whether the response confirms or invalidates the structure. Right now, the structure remains intact. If you are learning to read setups this way, drop a comment below. Just write watching so I know you're following the methodology, not just the price. The GSR breakdown and the Mexico supply crisis, the gold-silver ratio has now broken back below its 50-day moving average. The current GSR sits at 57. When the ratio compresses from elevated levels above 60, pushes through the 50-day moving average, and begins trending lower, it signals a sustained shift in relative demand between the two metals. Silver stops behaving like gold's chronically underperforming little sibling and begins outpacing it in both momentum and capital flows. The breakdown of the GSR below moving average support is one of the most historically consistent early indicators of extended silver outperformance. It does not happen often. When it does, the moves that follow tend to be meaningful in both size and duration. Now here's the supply variable that changes the entire macro backdrop of this conversation. Mexico is the largest silver-producing country on Earth. It supplies 50% of all silver imported into the United States. Not a significant portion, not a meaningful share, half. When supply disruption risk enters Mexico, it does not enter at the margins of the American silver supply chain. It enters right at the center of it. And right now, Mexico's mining sector is facing active, escalating operational threat. A few days ago, 10 workers from a mining company were abducted. 3 of them were found dead. That single incident has had immediate operational consequences across the entire sector. Mining companies are struggling to attract and keep employees in affected regions. Security costs have surged. Transport of silver ore and refined metal is facing active disruption, with logistics routes becoming increasingly difficult to secure. These are not projected risks. They are current operational realities that companies on the ground are managing right now. For context, that national security and the 5-year deficit makes this supply picture more serious than it might initially appear. Silver was recently declared a critical mineral for the first time in history. The designation was not symbolic. It reflects documented demand from AI infrastructure build-out and defense applications, both of which require silver, and neither of which has a near-term substitute. The United States has run scenario modeling, examining what supply disruption from Mexico would mean for the domestic economy. That modeling identified GDP impacts severe enough to generate national security concerns, not just supply chain concerns. When a commodity supply disruption is modeled at the national security level, the policy response that follows tends to be significant. This is all playing out against a market that has been in supply deficit for 5 consecutive years. Not 1 year, not a brief imbalance correcting itself. 5 consecutive years of demand exceeding supply, with CME vault inventories as the most visible evidence of that structural drain. And now the dominant supplier is facing escalating disruption at precisely the moment when the market is least equipped to absorb it. The compounding of a 5-year structural deficit with active supply disruption from a 50% import source is not a minor headwind. It is a fundamental shift in the risk profile of silver supply that will take time to fully price into markets that are still reacting to yesterday's roll data. Stabilization risks and the bear case. There are reasons to believe the Mexico situation stabilizes, and those reasons deserve honest treatment. The Trump administration's active coordination with the Mexican government on northern regional security appears to be generating early results on the ground. Cartel organizations tend to miscalculate when they're targeting shifts from vulnerable populations to economic assets owned by domestic and international upper-class stakeholders. Mining infrastructure falls squarely into that category. When cartel violence begins damaging assets of sufficient political and economic importance, the institutional response tends to sharpen considerably. Signs on the ground suggest genuine federal authority restoration efforts are underway. This is not yet a catastrophic supply collapse scenario, but the risk profile of Mexican silver supply has shifted materially, and markets that are already pricing a 5-year deficit do not absorb new supply risk neutrally. Now let's address the other side of this picture honestly, because the data has a genuine counter-argument and you deserve to hear it clearly. 71 million ounces rolled successfully yesterday. That means the mechanism worked. Positions that were expected to generate force majeure conditions moved without triggering a delivery crisis. That is a real outcome, not a minor footnote. If the remaining open interest, which sits at 115 million ounces against 87.2 million available, continues rolling voluntarily or opts for cash settlement over the next 48 hours, market counter-arguments and macro shifts, March settlement could complete without a major incident. That is a genuinely plausible scenario, not a wishful one. The $10 Shanghai premium is real and persistent, but premiums of this scale have historically narrowed when Chinese physical demand moderates seasonally or when Western supply sources reroute metal to capture the arbitrage. Neither of those conditions is impossible in the current environment. The GSR breakdown below the 50-day moving average is technically significant, but moving average breaks in commodity ratios can and do reverse sharply on macro shifts. A sudden dollar strengthening event, a risk-off move in equities, or a Federal Reserve communication that changes rate expectations could all exert pressure on the GSR in the near term. The Mexico security situation is escalating, but government coordination at the level now being applied could restore operational conditions faster than the current on-the-ground picture suggests. And the technical structure, while intact, has not yet confirmed the 92 objective with a close above it. Structure that identifies a target is not the same as structure that has reached it. Hold both pictures simultaneously. That is not weakness or indecision. That is the only intellectually honest way to operate in a market with this much live moving data. The people who get destroyed in setups like this are the ones who commit so fully to one scenario that they stop tracking the data when it sends a contradictory signal. Watch the data, follow the structure, stay logical. The psychology of short covering panic. Here is the psychological dimension that almost never gets discussed in market analysis, and it is the one that determines how the next 48 hours actually plays out at the individual position level. Daniel Kahneman documented in Thinking Fast and Slow how human decision-making defaults to System 1 thinking, fast, intuitive, emotionally driven during periods of high stress, rather than System 2, which is slower, deliberate, and logical. System 2 requires cognitive resources that stress depletes. A short position right now is carrying 48 hours to settlement, a $10 Shanghai premium that is not closed despite multiple sessions of opportunity to do so. 25 account suspensions at one of the world's most important physical silver exchanges. A GSR breakdown below moving average support. A rising 50-day moving average with price holding above it at 91, and an active supply shock hitting the dominant import source. That accumulation of simultaneous, unrelenting pressure is precisely the kind of environment that triggers System 1 panic responses, covering decisions made from fear of an unknowable outcome, rather than rational analysis of remaining risk. When short covering becomes panic-driven rather than strategically managed, it produces discontinuous price moves, not smooth, gradual adjustments, discontinuous gaps. That is what volatility pricing is currently anticipating. Gustave Le Bon documented in The Crowd how collective psychology in markets shifts suddenly and completely when a crowd realizes it is positioned on the wrong side of a structural move. Individual rationality does not hold up against collective momentum once the crowd recognizes its error. Le Bon's observation was that the shift, when it comes, is not gradual. It is sudden. 25 suspensions in a single month at SHFE signals that crowd positioning was so extreme it required exchange-level intervention to manage. That is not normal positioning noise. That is the kind of concentration that sets the stage for the sudden reversal Le Bon described. Not because of any single new data point, but because the accumulated weight of multiple simultaneous pressure variables finally crosses the threshold where the crowd can no longer rationalize holding. Critical indicators, spread and premium trends. Here is what to track specifically over the next 48 hours. If you want to understand what is building here without needing anyone to explain the outcome to you after the fact, watch CME registered silver. That 87.2 million ounce figure is the single most important number in this market right now. If it continues falling without replacement metal arriving, if Tuesday's pattern of outflow without inflow repeats on Wednesday and Thursday, the structural thesis holds and strengthens. If new metal begins flowing into registered stocks in meaningful quantity, the pressure valve gets some relief. Track that number session by session. Watch the March-May spread. When that spread flips from contango into backwardation, when the near-month contract trades at a premium to the deferred month rather than at a discount, expect physical outflows from CME to accelerate. Backwardation in a physical commodity futures market is one of the clearest signals that immediate delivery demand is overwhelming near-term supply availability. It does not happen in healthy, well-supplied markets. When it appears, the structural pressure it represents is not a paper phenomenon. Watch the Shanghai premium. If that $10 gap between Shanghai physical and Western spot holds or widens heading into Western settlement, it confirms that the structural dislocation between paper pricing and physical demand is deepening rather than resolving. If it narrows, it tells you something about Chinese demand conditions or Western supply routing that the current data does not yet show. SHFE enforcement and open interest resolution. Watch SHFE enforcement notices. They are published publicly. What the exchange does with enforcement in the next 2 trading sessions will tell you how concentrated risk still is on the eastern side of this market. More suspensions would signal that aggressive positioning has not been unwound. A clean enforcement record would suggest the intervention had its intended effect. And watch how the remaining 115 million ounces of open interest resolves. The roll window is closing. Cash settlement is an option, but forced delivery against a registered stock of 87.2 million ounces distributed unevenly across vault participants is the variable that is keeping every sophisticated short position awake right now. The resolution of that tension over the next 48 hours will tell you more about where silver trades in the second half of 2026 than any analyst note published this week. The sequence that builds from here, if the structural thesis is correct, unfolds in a specific order. CME registered silver continues its decline without meaningful replacement inflows. The March-May spread flips from contango to backwardation as near-month delivery pressure exceeds near-term supply. ETF investors who have largely missed the move to 91 begin recognizing that the price is not a spike but a new structural level. ETF buying begins in earnest. ETF buying removes additional physical silver from accessible market supply. That removal tightens the available inventory further, reinforcing the backwardation signal. and the retail investors who were watching from the sidelines, conditioned by years of silver underperformance to expect the rug pull, begin to realize the structure has fundamentally changed. Final outlook, tracking the vaults to 2026. The driver that will determine whether silver trades materially higher in the second half of 2026 is the same driver it has been for 5 consecutive years, demand proving larger than supply at the structural level, not just the daily trading level. The vault data is the most transparent, publicly verifiable way to track whether that dynamic is strengthening or weakening. At 87.2 million ounces, falling without replacement, it is strengthening. That number is the one to watch above all others. You have just walked through every major pressure variable in this market simultaneously: the CME vault data and its uneven distribution risk, the 71 million ounce roll and what the price response during that roll reveals, the Shanghai $10 premium and what its persistence signals about structural dislocation, the 25 SHFE account suspensions, and what exchange-level intervention confirms about crowd positioning, the technical break above 8,720 to 89 resistance, and the structure targeting 92, the GSR breakdown below the 50-day moving average, and what it signals about relative demand, the Mexico supply shock hitting at the worst possible moment in a 5-year deficit market, the honest bearish counter-argument that the roll worked and settlement could complete cleanly, and the psychological framework that explains how the next 48 hours could produce discontinuous price action that no one on the wrong side is prepared for. Most of what you just heard will not appear in mainstream financial coverage until settlement is closed and the price move is already history. The data is public. The CME reports are public. The SHFE enforcement notices are public. The Shanghai premium is visible to anyone who looks at both markets at the same time. The information has never been hidden. It has simply required the willingness to do the work of assembling it before the story is written for you. The people who understand what is building here are not special. They are simply willing to look at the data before someone else packages it into a neat narrative and delivers it to them after the fact. If this breakdown gave you genuine clarity on what is building in silver right now, share it with one person who has been watching this market but cannot make sense of the data structure, not because it helps the channel, but because they deserve to understand what is happening before it has already happened. Drop a comment that says exactly OG John AG 2.0. That is the signal I look for to know you made it through the full picture and absorbed the complete data set, not just the opening hook. If the numbers did the talking today without needing the hype, hit like, and if you want to be in this room in real time for the next 48 hours as this settlement resolves, subscribe. The data does not wait for anyone. Invest with logic, never with emotions, never with impulse decisions, and never with hype. 48 hours. Watch the vaults. OG John AG, signing off.